You've made the decision to purchase an investment property but aren't sure how to go about it. Well, if you aren't in a position to pay cash, you'll want to know the mortgage options available and what makes financing an investment property different than a primary or secondary residence. In this video, I'll explain what lenders are looking at when financing investment or rental properties, the additional costs that come along with them, and the types of loans available to help you make that purchase. So first, let's talk about the down payment requirements when you're purchasing an investment property. The minimum down payment on an investment property is going to be 15%, and that would be using a conventional mortgage. Now, if you're buying a primary residence, you can actually put down as little as 3% if you're a first-time home buyer, 3.5% if you're eligible for FHA financing, 5% if you've owned a home in the past. But on an investment property, your minimum down is going to be 15%. What's cool about buying an investment property, and you may not have known this, if you already own another property or you've been paying rent for at least 12 months on a property, we could use rent from the property you're buying to help you qualify to buy that property. And here's what I mean by that. Let's say you're buying a single family home and that property has market rent of $4,000 per month, right? We determine the market rent by having the appraiser, who's the person who goes out to the home to determine the value, also do a rent schedule where they're going to pull up comparable properties to the one you're buying to see what those rent for on a monthly basis. We can actually consider the future rent that you're going to receive based on that market analysis toward qualifying for the property. So let's just say that the new payment on the home you're buying is going to be $3,000 a month. Well, like I said, if the market rent's $4,000, that's fantastic. We can take 75% of that $4,000 figure, and what that 75% is, it takes a 25% vacancy factor, or assuming the property sits empty 1/4% of the time, which is leaves 75% we can use. So that's $3,000. 75% of 4,000 is 3,000. That means $3,000 of net rental income that we can use can offset the $3,000 of housing payment from that property you're buying, and it's a complete wash in that case. It's like you're not even incurring an added expense. So your debt to income ratio, the money you make monthly versus what you spend monthly, including the new property, isn't even going to change with the purchase of this property, at least in the eyes of the lender. So it may be easier to qualify for an investment property than you might have realized based on that alone. Now, a negative with investment properties? Well, they have higher interest rates, right? They're higher risk property types. If someone runs into financial hardship, let's say you run into financial hardship and you own a primary residence and you own an investment property, the likelihood of you letting that investment property go versus your primary residence is probably very high if they had to make a choice between the two. So those property types are higher risk, especially if they're relying on rent to support the monthly payments. And the higher risk something is, the higher the rate that comes along with it will be. The only way to counteract that higher rate is to put a higher down payment. Ideally, although you're allowed to put as little as 15% down on an investment property, you really want to put 30% down if you're able, because it's going to help balance out that higher rate for you and the costs that come with it, which brings me to my next point. Investment property loans have higher costs, meaning you're going to have to pay discount points. I've yet to see a loan for an investment property where someone does not have to pay discount points, meaning upfront money, to pay for their interest rate. And I'm not talking about just to get a lower interest rate. I'm talking to get a rate in general, especially if you're leaning toward the 15% option. If you're going to do 15% down, you need to plan that you're going to be paying discount points. So you might be out of pocket closer to 19% once you factor those discount points in on top of your down payment. Now, I mentioned you can do a conventional loan as low as 15% down on investment properties. You can use rent to help offset the payment, assuming you at least have a housing payment of some type for the last 12 months. If you have a landlord history, maybe you've owned another property, we can actually use a surplus on that market rent, right? I told you before that we can wash away your payment, but what if there was a surplus once you take 75% of that market rent? Well, that would give you positive income toward qualifying, right? So it reduces your debt. It doesn't keep your debt to income ratio the same. It actually would reduce your debt to income ratio in those circumstances. But to do that, you have to have a 12-month landlord history so we can use the surplus of income. Now, an alternative to a conventional loan, let's just say that you don't want to show income, or maybe you can't show income to qualify, right? is a DSCR loan, a debt service coverage ratio loan. And what DSCR is, it means that you're going to use the rent for the property to offset the payment for the property. It's really that simple. Most of the time with these types of loans, you're gonna have to put at least 20% down. And in an ideal world, your DSCR, debt service coverage ratio, is 1-to-1, meaning that the payment on the property is equal to the rent on 100% of the rent on that property, right? So same example, let's just say that you had a $4,000 payment for a property. Well, the rent that that property brings in based on a market analysis, again, done by the appraiser, would need to be $4,000. If those two numbers are equal, you wouldn't have to verify any income or employment. It's simply just based on the rent. That's what this type of loan is for. But these are only for investment properties, rental properties. You can also use it for short-term rent as well as long-term rent. One other alternative as far as a loan type is concerned, if you're self-employed, would be a bank statement loan. A bank statement loan utilizes your bank statements, whether it's 12 months or 24 months, either personal or business bank statements, to qualify you for a property instead of providing traditional income documents. So let's just say you're self-employed and you write off all your income on your tax, or I should say your CPA writes off all your income on your tax return, and the number that shows on there would not support the priced home you're looking to purchase. Well, a bank statement loan may be a great alternative, and those types of loans can be used to buy investment properties and work the same way I'm mentioning. But it would use your deposits going into your bank account. It would subtract an expense ratio based on what your CPA says that might be. And what's left is the usable income toward the purchase of a property, in this case, an investment property. So, like I said, it may be easier to actually qualify for an investment property than you might have realized. Maybe you own a primary residence now. You thought it was near impossible to buy an investment property because you think that you can incur the additional debt that it's going to add to your ratios. But this video might be helpful because now you realize that, wait a minute, I can actually use the future rent from that property to qualify, and I no longer have to worry about counting that in my debt ratio, right? So keep that in mind if you're considering buying a property in the future to use for rental purposes, investment purposes. And now that you have a better understanding of investor-specific loans, I hope you have more confidence in becoming one. If you have any questions about your specific scenario, please leave a comment below. I reply to 100% of the comments left on my videos, and make sure to subscribe if you'd like to continue educating yourself on all things mortgage and real estate related.